For 6 years running, one American magazine gave the same company the same award, America's most innovative company. Wall Street analysts loved it. Business schools taught it as a model of the future. Politicians courted it. And at its peak, this company was worth more than $70 billion, employed over 20,000 people, and claimed annual revenue of about $100 billion, enough to rank it 7th on the Fortune 500. 18 months later, it was gone. Not shrunk, not restructured, gone. The largest bankruptcy in American history at the time, a stock that fell from roughly $90 a share to a few cents, and a name that became a punchline for corporate fraud almost overnight. Employees who had put their retirement savings into company stock watched it evaporate in weeks. The strange part isn't that Enron collapsed. Companies collapse. The strange part is what it actually sold. Ask most people what Enron did, and they'll tell you it was an energy company, pipelines, oil, gas. That's true, but only in the sense that a casino is a building with chairs in it. By the time Enron fell apart, its most important product wasn't gas or electricity. It was a number on a balance sheet, generated by a trading desk, describing a contract for something that might be delivered years in the future or might never exist at all. Enron didn't just sell energy. For a while, it sold the idea that a company could conjure profit out of thin air and call it innovation. This is the story of how that idea was built, why it worked long enough to fool nearly everyone, and why it was always going to fail. Enron was born in 1985, out of the unglamorous business of moving natural gas through pipes. Kenneth Lay, an economist with a talent for navigating Washington and Wall Street in equal measure, had been running Houston Natural Gas when it fended off a hostile takeover bid from a rival coastal corporation. The defense worked, but it left Houston Natural Gas looking for a bigger partner, and it found one in Internearth, an Omaha-based pipeline operator with roots stretching back to the 1930s. The two merged, briefly operated under the clunky name Hung Internearth, and within a year rebranded as Enron. Lay took the top job and moved the headquarters to Houston. On paper, this was a pipeline company, a business built on physical infrastructure, regulated tariffs, and thin, predictable margins. That business model was already dying when Enron was created. Federal deregulation was dismantling the old system in which pipeline operators bought gas, moved it, and sold it at a guaranteed markup. Once that system unwound, pipelines became more like toll roads, companies that owned the pipes but no longer controlled what flowed through them or at what price. Enron inherited a mountain of debt from the merger and a business model that regulators were actively taking apart from underneath it. The man who solved that problem was not an oil and gas veteran. He was a former McKinsey consultant named Jeffrey Skilling, who arrived at Enron with an idea borrowed from Wall Street rather than from the gas fields of Texas. If Enron couldn't make money moving physical gas at a fixed markup anymore, it could make money the way a bank makes money, by matching buyers and sellers of financial contracts and taking a cut in the middle. Skilling called this the gas bank. Producers who wanted price certainty and industrial customers who wanted reliable supply could each sign long-term contracts with Enron instead of with each other, and Enron would sit in the middle, managing the risk and pricing the spread. It was, in effect, the transformation of a pipeline company into a trading firm that happened to also own some pipelines. This is the turning point that explains everything that came after. To make the gas bank model work, Enron needed a way to record the value of these long-term contracts today, rather than waiting years for the cash to actually arrive. In 1992, the Securities and Exchange Commission approved Enron's request to use mark-to-market accounting for its natural gas trading contracts, a method that lets a company book the estimated present value of future profits from a contract immediately, based on its own projections of future prices, rather than recognizing revenue as cash actually comes in. For a bank trading standardized securities with a visible market price, mark-to-market is a reasonable way to reflect value. For a company writing decades-long, custom energy contracts with no liquid market and no independent price to check against, it hands enormous discretion to the company itself. Enron, in practice, got to decide how profitable its own deals were, years before anyone could verify whether those profits would ever show up as real cash. That single accounting decision is the hinge the entire company eventually swung on. It let Enron report soaring profits from trading activity almost as fast as it could sign new contracts, regardless of whether the underlying business ever generated the cash those profits implied. And it created a permanent structural pressure to keep the stock price climbing. Enron didn't just need real cash flow. It needed to keep manufacturing bigger and more optimistic assumptions about the future, deal after deal, forever. Enron's actual power, in its healthiest years, came from something more concrete than accounting tricks. It built genuine infrastructure and genuine market position. It operated one of the largest networks of natural gas pipelines in the country. It became the largest buyer and seller of natural gas in North America, and later did the same in electricity, essentially building the market itself, setting the standard contracts, the pricing conventions, and eventually the trading platform that the rest of the industry used. In 1999, it launched Enron Online, an internet-based trading system that let counterparties buy and sell energy contracts directly with Enron in real time. It was, for a period, the largest e-commerce platform in the world by transaction volume, handling more dollar value in a single year than Amazon and eBay combined. That was real infrastructure, real market share, and a real network effect. The more counterparties who traded through Enron, the more liquidity it offered, and the more it made sense for the next counterparty to trade through Enron too. Enron's pricing power, such as it was, came from being the counterparty everyone else needed. If you were a factory owner trying to lock in a stable price for natural gas 5 years out, or a utility trying to hedge against a spike in electricity costs next summer, Enron could offer you a customized contract that no exchange-traded product could match because it had the trading desk, the market data, and the balance sheet to absorb the risk on the other side. That's a real service and real customers. Industrial manufacturers, utilities, municipalities paid for it because the alternative was bearing that price risk themselves. Switching away from Enron meant finding another counterparty willing to structure an equally specific deal at a moment when Enron effectively set the going rate for what specific looked like. That's a meaningful form of lock-in, but it's worth noting it's the lock-in of a dominant market maker, not the lock-in of a monopolist controlling a resource nobody else can supply. A utility could, in principle, go to Dynegy or Williams instead. It just usually got a worse price, because those firms had less trading volume and less data to price the risk as tightly. The trouble is that market-making power and mark-to-market accounting are a dangerous combination. A company that sets the market can also be tempted to set its own valuations within that market, with limited independent scrutiny. And a company under constant pressure to report ever larger paper profits will eventually look for places to hide the parts of the business that aren't producing them. Enron found those places in a set of related businesses that were, by any honest accounting, expensive failures. Rebecca Mark, who ran Enron's international division, pursued an ambitious slate of overseas power and infrastructure projects, the most notorious being the Dabhol power plant in India, a multi-billion-dollar gas-fired plant that became mired in political disputes, unpaid bills, and years of controversy before it ever ran reliably. Enron also built Azurix, a water utility venture, and Enron Broadband Services, a bet that the company could apply its trading model to bandwidth the way it had to gas and electricity, just as the dot-com bubble was cresting and then bursting. None of these ventures delivered anything close to the returns Enron had promised investors. Dabhol alone tied up more than $2 billion of investment in a plant that spent long stretches sitting idle because the state utility that had agreed to buy its power couldn't or wouldn't pay the contracted price. A reminder that political and currency risk in emerging markets doesn't disappear just because a trading company is confident it can price around it. Azurix, meanwhile, discovered that water utilities are slow-moving, heavily regulated, low-margin businesses almost by design, nothing like the fast-turning energy contracts Enron's culture had been built around. Each of these was, on its own, a normal corporate misstep, the kind that plenty of ambitious companies survive by writing down the loss and moving on. Enron's problem was that its culture had no mechanism for absorbing a loss quietly. Trading desks were rewarded on the profits they booked immediately, and the entire company was under pressure to keep showing growth every quarter. So a failed bet had to be hidden rather than digested. Rather than absorb those losses and admit the strategy hadn't worked, Enron's chief financial officer, Andrew Fastow, built a web of off-balance sheet partnerships, entities with names like Chuco and the Liam Partnerships, that existed largely to buy troubled Enron assets, take on Enron debt, and keep both off Enron's own financial statements. Some of these entities were technically structured so that Enron didn't have to consolidate them into its books, as long as outside investors held a small minimum stake. In practice, many of those outside investors were funded, guaranteed, or otherwise backstopped by Enron itself, and Fastow personally profited from managing several of them, a direct conflict of interest between his duty to Enron's shareholders and his own financial stake in the partnerships he was doing deals with. The effect was that Enron could report rising profits and a healthy balance sheet, while quietly shifting billions of dollars in losses and debt into structures that investors and even most of Enron's own board couldn't see clearly. For a few years, this worked, in the sense that the stock kept rising and the awards kept coming. It worked partly because Enron's auditor, Arthur Andersen, one of the most respected accounting firms in the world at the time, signed off on the arrangements, and partly because very few outsiders had the incentive or the information to ask hard questions about a company whose business had become, by design, difficult to understand from the outside. That opacity wasn't an accident. A trading company's edge depends on knowing more about pricing and risk than its counterparties do, and Enron cultivated the same opacity toward its own investors that gave it an advantage in the market. The cracks started showing not in a courtroom, but in a magazine. In March 2001, Fortune writer Bethany McLean published an article simply asking how, exactly, Enron made its money, a question that turned out to be strikingly hard for the company to answer in plain terms. Around the same time, Enron's trading desk was playing a very different, very public role 3,000 miles away. California's newly deregulated electricity market was suffering rolling blackouts and spiking prices, and federal investigators later found that Enron traders had exploited quirks in the market's rules, creating artificial congestion, scheduling power to run up prices, and other strategies with names like Death Star and Fat Boy to profit from the chaos. It was a preview of a company whose cleverness had detached from any obligation to the systems it operated inside. Regulators at the Federal Energy Regulatory Commission later documented these trading strategies extensively, using Enron's own internal communications, and the episode did lasting damage to the broader case for energy deregulation itself. For years afterward, any state considering opening its electricity market to competition had to reckon with California's example as a cautionary tale, whether or not the comparison was entirely fair to different market designs. By August 2001, Skilling, who had become chief executive earlier that year, abruptly resigned, citing personal reasons, after only a few months in the job. That same month, an Enron vice president named Sharon Watkins sent Kenneth Lay an internal memo warning that the company's accounting practices could cause it to implode in a wave of accounting scandals. Lay met with her, and outside counsel reviewed some of her concerns, but the underlying structure went unchanged. Through the fall, as more details of the off-balance sheet partnerships came to light, Enron was forced to restate several years of earnings downward and disclose a material reduction in shareholder equity. Credit rating agencies downgraded the company's debt to junk status, which triggered clauses in some of those very partnerships requiring Enron to repay obligations immediately, a self-reinforcing collapse where the disclosure of hidden debt created a cash crisis that made the company's real financial position even worse. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection. What makes the collapse worth studying isn't just its speed but its mechanics, the specific way a company this large can go from investment grade to worthless in a matter of weeks. Most corporate failures are slow, a business loses relevance, margins shrink, debt piles up, and the end is visible years in advance. Enron's failure was closer to a bank run, the moment investors and rating agencies stopped trusting the balance sheet. Every counterparty who had signed a long-term trading contract with Enron had to ask whether Enron would still exist to honor it, and stopped trading with the company almost immediately. A trading firm's entire value depends on counterparties believing it will be solvent tomorrow. Once that belief cracks, the business itself, not just the stock price, disappears within days, because nobody wants to be the last person holding a contract with a bankrupt counterparty. The aftermath extended well beyond Enron itself. Arthur Andersen, convicted of obstruction of justice for shredding Enron-related documents, effectively ceased to exist as a firm even before the U.S. Supreme Court later overturned that conviction on narrow legal grounds. By then, the damage to its reputation was irreversible, and one of the big five global accounting firms simply disappeared. Andrew Fastow pleaded guilty to fraud and served time in federal prison after cooperating with prosecutors. Skilling was convicted on multiple counts of fraud and conspiracy in 2006 and served over a decade in prison before his sentence was reduced and he was released in 2019. Kenneth Lay was also convicted in 2006 but died before he was sentenced, and his conviction was later vacated as a result. Roughly 20,000 employees lost their jobs, and many lost retirement savings that had been heavily concentrated in Enron stock through the company's 401k plan, a detail that did more than any regulatory statistic to turn Enron into a national symbol of corporate betrayal. It's worth being precise about what kind of company Enron actually was, because the myth of the company that controlled everything oversells the case in one direction and undersells it in another. Enron never had a monopoly on natural gas or electricity. Competitors like Dynegy, Duke Energy, and Williams companies operated in the same markets, often with more conservative balance sheets that let them survive Enron's collapse, and, in Dynegy's case, briefly attempt to acquire the failing giant before backing out once the scale of the hidden debt became clear. What Enron did have, for a window of a few years, was something rarer, and in some ways more dangerous than a monopoly. It had built and controlled the market's plumbing itself, setting the standard contracts and running the dominant trading platform, while simultaneously being one of the parties trading on it. That's not market dominance through better pipelines or lower prices. It's dominance through information. Asymmetry, knowing the market better than anyone else, because you built it, combined with an accounting framework that let you report the benefits of that information. Asymmetry as profit before you'd actually collected on it. Take away the mark-to-market rules and the off-balance sheet partnerships, and Enron is a mid-sized pipeline and trading company with a genuinely important, but not extraordinary, market position. Add them back in, and you get a company whose reported success was, for years, disconnected from its actual cash-generating ability. Enron doesn't exist today to have a current position in the ordinary sense. The last vestiges of the estate, Enron Creditors Recovery Corporation, wound down operations in 2007 after selling off remaining assets and distributing what it could to creditors, who ultimately recovered only a fraction of what they were owed. But the company's afterlife has been enormous. Congress passed the Sarbanes-Oxley Act in 2002 in direct response to Enron and the accounting scandals that followed it, creating new oversight of public company audits, criminal penalties for destroying financial records, and requirements that CEOs and AFOs personally certify their company's financial statements. The Public Company Accounting Oversight Board exists because Enron happened. Rules restricting how much non-audit consulting work an accounting firm can sell to a client it audits exist because Andersen was doing both for Enron and had every financial incentive not to ask hard questions. Every time a company today discloses a special purpose entity or an off-balance sheet arrangement in a footnote that regulators specifically require, that disclosure requirement traces back to Fastow's partnerships. There are two ways to read what Enron ultimately reveals about corporate power, and both are worth holding on to. One is that sophistication itself can become a weapon, that the same financial engineering that lets a company manage genuine risk, hedge real exposure, and build genuinely useful markets can be pointed inward at the company's own investors once the incentive to keep a stock price climbing outweighs the incentive to tell the truth about how the money is actually made. The other is more mundane but just as durable, that markets, however clever the participants, still depend on someone outside the company being able to verify what's actually happening inside it. An auditor with no conflicting incentives, a regulator with real authority, a rule that says profit isn't real until the cash is. Enron didn't fail because energy trading is inherently dishonest, or because Kenneth Lay and Jeffrey Skilling were uniquely evil among American executives. It failed because it built a machine that could report success indefinitely without ever needing the underlying business to actually deliver it, and for a while, almost nobody with the power to stop it had the incentive to ask how the trick worked. That's not a story about one company. It's a story about what happens whenever growth is measured by numbers a company gets to choose for itself.